Hi, John. Chipotle earnings coming in with EPS right in line at 33 cents adjusted. Revenues just slightly below estimates, $3.06 billion for Q2. Analysts were looking for $3.11 billion. Same store sales came in lower than expected, down 4%. Analysts were projecting a fall of 2.9%. This is its second consecutive contraction and also the biggest since the second quarter of 2020. Chipotle, though, reporting a return to positive comparable sales and transactions in the month of June. Its restaurant level margins right in line at 27.4%. The company noted inflation across several of its key ingredients, primarily steak and chicken. For the full year, it's cutting guidance to about flat for full year comp sales. That's down from the prior guidance of low single-digit growth. In a statement, CEO Scott Boatwright said the company was seeing its momentum build as it rolled out its summer marketing initiatives and comparisons ease. You can see the stock is down just under 9%. And joining us now to hear more about the quarter is Scott Boatwright. Scott, thank you so much for being here.
Hi, Kate. Thanks for having us on today.
Great to see you. So I do want to talk about the trend that you mentioned in June in this release. Last quarter, you said you felt the company could get back to those positive transactions in the back half of the year. You did see that trend last month. Do you think it's sustainable?
I do, Kate. You know, we saw some real consumer softness that was really unexpected back in the May timeframe. When we saw consumer sentiment drop to an annual low, and oftentimes we trend along with consumer sentiment. So we didn't anticipate that, which has caused us to re-guide the year, unfortunately. But I'm happy to report that we've seen an acceleration in the business in conjunction with our summer campaign around Summer of Extras and digital, as well as the new Adobo Ranch Dip, which we launched in the beginning of June, is driving transactions and uplift as well.
And I'm wondering about varying income cohorts. How are they performing, and where's the company seeing the most resistance from the consumer right now?
Yeah, we saw a bit of a step down in the low-income consumer in the April-May timeframe. We think that's in large part due to really tough compares from prior year. But we've seen that rebound with our summer campaign, which gives me confidence that we can return to positive growth and positive transactions in the second half.
The consumer, as we all know, is so value hungry right now. How are you seeing that turn up in your customer base, and how do you plan to address it in the back half of the year as we all forecast this trend is likely to continue?
Yeah, I think the brands that are winning right now in this space are brands that are innovating and meeting the consumer where they are. You know, we think about value differently. We haven't been a brand that's competed on value as a price point. We think about value as benefit over price, and delivering high-quality, fresh ingredients with classic culinary techniques in abundance at a speed at which you can't get anywhere else is really the core equities of our brand and really where the value proposition rests. What we can do differently is think differently about innovation in the back half, and of course, as we think about the 2026 calendar, whether that's LTOs, center-of-the-plate items, dips, or sides, or other interesting ideas that we have in the hopper. We're thinking differently about group occasions for the second half of the year and how we lean into, meals around 4 people or 6 people, as well as launching our catering test in the back half of the year, which is another exciting platform that we plan to lean into more meaningfully in 2026.
You did note inflation in some of the key menu items, primarily chicken and steak. Wondering more broadly, have you felt any direct or indirect impact from tariff headwinds?
No tariff impact to date, Kate. I will tell you, we are seeing modest inflation, so think low single digits in both cost of goods as well as labor. That's ordinary and expected. We do believe there will be some tariff impact in the back half of the year. Could be anywhere in the range of 30 to 50 basis points. But I'm happy to report that between risk mitigation strategies with our current suppliers and vendors, as well as how we think about margin improvements within the business, we believe we can offset those tariff impacts in the back half of the year and remain really aggressive as we think about overall restaurant level margin and EPS for the back half.
And Scott, Chipotle has long invested in its technology pipeline and things that make the back of the house run, more smooth for your staff. I'm wondering if you can talk about labor costs and some of the investments that you've made to bring down costs on the labor front in your kitchens.
Yeah, we have a couple of things that are in flight at present, Kate, which we're excited about. The produce slicers are now in all restaurants. The teams are still working on the training and cascade rollout for those slicers. The restaurants that have had them the longest at this point are seeing labor efficiency gains, which is exciting, obviously contributing to our bottom line. We don't have the full fleet trained and ready and rolling yet, but we believe there'll be greater efficiencies there. We also talked last quarter about the high efficiency equipment package, which will start rolling this year. We'll get to about 160 restaurants retrofitted this year. We'll start a full retrofit of the existing fleet sometime in the back half of the year. And all new restaurant openings in Q4 will have the new high efficiency equipment package, which will have several gains, none of which are more important than the culinary gains that we expect to see on taste of food and quality and consistency of cut size. But there'll also be efficiency gains in labor as well.